I think if you got to at about the middle of May, things looked pretty good, and we were fairly optimistic on the outlook for the year. And then you started getting, from the middle of May, problems starting to erupt in Europe, and life started getting fairly much tougher because equity markets started getting very volatile. And then you started moving towards July, and certainly by the time you got into the back end of July, it looked like we were running through a massive problem with on two fronts. One on the US, where the legislators couldn't agree the cap on US spending, and obviously that followed on with a rating downgrade, because I think the rating agency just felt that legislators in the US are impeding economic recovery, and there is just no discipline. Obviously that didn't really have that much effect on the US ability to borrow, because it's still a safe haven, but it did affect sentiment. And then this European thing, where what you're seeing is leadership in Europe not knowing and not understanding that words don't help, and you can't talk up your currency, you can't talk up to save a problem. You actually have to have action, and they have to get ahead of the curve, and everything they do is behind the curve, and it just makes the market more and more skeptical and keeps going after them.
Well, in terms of your skepticism, we know that over the period, and last week Friday we actually spoke about the Evolution acquisition focused particularly on the Williams de Bro division. Clearly you are optimistic about the future to embark on acquisition during this time. Tell us about the thinking behind this, and we know that synergies still need to be bedded down.
Yeah, I think what Evolution is, it's a private client wealth manager and manages about £7.8 billion. And an investment bank. Now obviously we in both those businesses, so we have platforms in which we can integrate those businesses into. They're non-capital intensive businesses. The investment bank, clearly investment banks around the world will be going through a tough time because of lack of deal flow and weak market conditions, but that persists for a while, and then life recovers. So it does broaden our footprint in the investment banking side. There are a whole lot of areas that we don't cover that they cover, and on the wealth and investment side, over time we'll integrate it into our platform, which is called Investec Wealth and Investments, and that increases our funds under management in that business by almost 50%, and it makes us a major player in the UK market. In fact, I think we as a asset manager, if you think we came out of South Africa, manage over £1 trillion rand of third-party funds, which is quite significant as an overall firm.
You were talking a little earlier with regards to financial risk, trading risk and operational risk, and you've alluded to the fact that Williams de Bro hasn't actually taken any financial and trading risk. What kind of scenario do you foresee playing out within that division and your role with regards to that?
Well, it's a private client wealth manager, so they look after third-party money. It takes operational risk, because that's, you know, making sure that the money is managed properly, making sure that the systems work, that you give the client the right information, and that there's you know, proper segregation of the funds and all those kinds of things, which are normal for us because we do it in a lot of places. So you know, we really believe that given time, that when that business is fully integrated, we'll get a decent return out of it, and it does give us a lot more scale.
When you look at your impairments at 0.9%, so only at 0.9%, from 1.3% in March, so a significant improvement there. You have cited a few concerns coming through from Ireland. Give us your sense in terms of how things could turn around and whether you can maintain the below 1% ratio.
Yeah, I think the thing is, for our type of business, normal is at about 0.3 to 0.4. So we're still, as we said, at elevated levels, but it is starting to normalize as we deal with some of the problems of the past. And you know, I'm talking to the end of September. Obviously 0.9 is less than what we wrote off last year. In the second half was much higher than 1.27. The first half was 0.98, and we believe that for the overall year, you know, we would be at a much lower number than last year. And that's because we are dealing with the issues. Obviously the world is in a funny place, and there's talk of double-dip recessions. I still think that, notwithstanding the fact that they're double-dip recessions, I don't believe we'll have a double dip, but I still think that, you know, we will see lower impairments next year, this full financial year, than we saw last year, because we took the heat last year.
Also, just taking a look at your capital adequacy ratios and meeting the Basel III requirements, it seems that you are on track with regards to this. But another new scenario that is playing out, the Independent Commission on Banking in the UK, new regulation, and that basically means to ensure that investment banking is not very integrated into the retail side of things. Give us your assessment with regards to the scenario and how it will affect Investec.
I think they've been flexible on where you put the fence, and they probably said, a lot of corporate type activity can sit inside the retail bank, provided you're prepared to live with a higher capital regime. We would probably want to put a lot of stuff inside the fence, but it's still a long time to go before you work all this out. So we'll have to work at what the optimal structure is for us. Our conclusion is that it's not as draconian as it could have been, and there is a fair amount of flexibility in the Independent Commission's report that should enable us to have moderate adjustment to our business model.
With regards to South Africa, UK and Australian operations, give us your sense, which divisions are you most optimistic about in the future that you will be pushing aggressively as the biggest growth scenario? Well,
it depends on the season. So, up to the last couple of years where banking has been a bit of a swear word, you've seen very strong growth in our asset management businesses, and I think that as you move on, banking will become fashionable again, and everyone will get off the bank's backs as they see the important conduit in society to help growth and development. And I think that in time we'll start seeing a much bigger contribution from our specialist bank, but certainly we have been trying to build our non-banking revenue at the same time. So last year we were 37% asset management and wealth management revenue. That we would like to see at a higher number overall, but I do think that you're going to get a turnaround in your banking businesses and your investment banking businesses at a point in time.